All right, let's see here. Let me just do a couple of housekeeping items and we'll be ready to roll. Boom. All right, so welcome to Credit Direction 101. We're going to talk about some simple credit direction, credit repair concepts, and details, information, etc., so you can help more clients qualify and ultimately, hopefully, sell more homes. We are going to cover a number of different things. I'm going to start actually with a question that I got yesterday that I haven't prompted Jordan on, but should be, I think, a great lead into this. Before we get to any of that, the replay, the on-demand replay of this session will be available immediately after at the same link that you were invited to join us at. We also take these and we upload them to the Wake Up Real Estate YouTube channel and wakeup.realestate, and you'll find that on those platforms within 24 to 48 hours of the live session. If you have a client or just want to chat about any mortgage-related questions, scenarios, etc., you can get to me here or here, and I will pop Jordan's info in the chat as we go as well. And Jordan, I'm going to, I don't want to say throw you a curveball, but
Okay.
I'm going to start with something that was a question I got yesterday from one of our referral partners. And I think this topic prompted the question, which is or was, what are the credit score minimums or guidelines for the different types of financing options that we have available here at NEXA Mortgage? So I thought this might be a great lead-in for several reasons. I think it's great information for everyone on here to have and be knowledgeable about, number one. Number two, there may be clients. In fact, I can virtually guarantee that there are clients in your database. There are clients that you've chatted with at some point in the near or distant past that might qualify and you didn't realize it. Okay. And number three, I just also wanted to highlight, a number of the different programs and products that we have and just help you have a better understanding. So, Jordan, FHA financing. What are the credit score guidelines or thresholds?
They go down to 500 on a credit score with 10% down. So 500 to 579 with 10% down, and then 580 plus is 3.5% down. So it doesn't mean that we're going to get an AUS accept, but this just means that it's possible. Like I've done home loans at a 503 credit score. A few months ago, I closed 3 home loans in the 520s in 1 month. So it is something that if they have money, 10% down, the likelihood is even greater at, like, let's say a 560 credit score with 10% down than a 580 with 3.5% down. They look at it as at the 10% mark, it's a big bonus when running automated underwriting for FHA.
Yep.
So
if you're like me, you may not, this may be a revelation to you that you can actually, that we can help borrowers below 680. It was for me just a few short years ago when I learned this. I've been in the industry for a long time and I didn't know it. Jordan, just briefly, let's talk about why there may be people on here who have had clients that were turned down by lenders, even though they were at these thresholds.
So
why does that happen?
Let's talk about how guidelines work really in general. So you have FHA, this is a perfect mix right here. FHA, USDA, VA, and conventional. FHA, it goes by HUD's handbook. Okay. But HUD's handbook is just it's your baseline of guidelines. And then you'll have lenders, let's say like Cross Country Mortgage or Leader One Financial or Wells Fargo, that might do FHA home loans, but they would have what is called overlays. Yes. It's, hey, we agree with most of the rules, but we don't want to play in the realm of 580 and below, right? And they'll have an overlay that says their minimum for FHA is 580. I would say most banks, 99.9% of banks. So we work with over 240, for example, banks. Only 5 for us go below uh, a 580 credit score. Just to give
Well,
you
you
a,
say only 5, but that's 5 more than most people have
yeah,
available to
yeah,
them.
only 5. Yeah, it is 5 more than most people have available. But that just gives you an example on how many people have overlays. We have every one of what banks that we work with have overlays too. We just need to know like what box, what bank will fit with what. It's very common for some sort of overlay, but there are lenders out there like EPM that we use that don't have overlays on anything. Even on other products, not just FHA, but VA, USDA, and conventional.
Yep. All right. So I'm putting in the chat contact info. I forgot to mention in my housekeeping item spiel, we want your questions, your feedback, your scenarios. So please, please, please put them in the chat or put them in the Q&A box. Or if you're watching after the fact, you can comment or just reach out directly if you have a question scenario. One last thing on FHA before we move on, because we've talked about this before. If we are trying to combine FHA with down payment assistance, does that affect our credit score minimums?
Yeah. So anytime you move, I guess the threshold or what I would call the borrower's investment, you're going to have a higher minimums required. Our current minimum for FHA down payment assistance is 580 with an AUS accept. So the likelihood of getting you an AUS accept at a 580 down payment system is low, but it just depends on their compensating factors. What other scenarios do they have? You know, it's just possible. We're just saying it's possible.
Possible.
Per
Where
the lender's
would it
guidelines.
be? Where does at what number, generally speaking, does the probability increase?
620 to 640
Okay, so
usually.
620 to
That's usually my
640.
my minimum
Um,
that I
yeah,
try to shoot for. When I'm giving
BPA
someone,
more likely.
we talk about a lot of times what, the 3 pillars, income,
Yep,
credit, and assets. This
yep,
is a lot that what we're doing, the whole time is how do I put someone in a position to buy if they're not ready to buy? About 75% of people don't qualify today. I personally know, I mean, as you know, I try to take this outlook when I'm working with real estate agents. I take the outlook of you probably contacted them 17 times to even get it over to us. So I should try to explore every single option on a path forward to get them the closest and quickest way to get them to a range to buy a home. So a lot of times it might be, okay, we don't have any money and our credit score is 580. I might give them credit direction. Our goal is to shoot for a 640, for
yep,
example.
yep.
And we try to manipulate that score up so we can get into a range, and so that we're not missing as many of those pillars or those stools uh, to qualify them.
Anytime you all refer us a possible client, the value we're bringing to you, or there are a number of things, but the biggest thing is being able to look at the puzzle or the pieces of the puzzle and figuring out the best way to fit it all together based upon their situation and scenario. So getting them, finding, not just knowing how the pieces are going to fit together best, but also what lender then we can take that puzzle to that's going to work within that framework or those pieces, right? So that I would say is one of our value propositions when you've got a potential client and you're looking for the best opportunity to help them. USDA credit score minimum.
580. I mean, most companies will have a minimum of 580 on this. I would
It's
say
more
you're really
typical
looking at
620.
620,
Yeah.
620 to 640 is really what you're looking at. I would say out of all the products besides conventional, this is going to be more across the board with everyone. Everyone's going to have the same exact guidelines. They're not going to move too far off from what USDA has.
Okay. And
So
just one quick note on USDA. If you don't know, that's quote unquote rural, for more rural properties. And so not only does the client have to qualify, but the property has to qualify. It has to fall within a USDA boundary that you can Google to get the USDA map, or just reach out to us. We can get you that link. If you're not sure, maybe you have a listing and you're not sure if it would qualify for USDA, or you have clients that are looking at listings and you're not sure if any of those might qualify, we can help with all of that. All right, VA.
There are none. There are no credit score
None.
requirements.
Okay,
Yeah.
so now people are, people are like, wait, what? So is there anything? So because there are no credit minimums on VA, or are there other things that folks should be aware of if they're talking with a potential VA borrower?
Uh, well, most banks are going to have overlays of something, right? Where I would say the typical is about a 600 credit score. There's still a 0% down program. So you still want to see anywhere from 600 to 640 credit score a lot of times on VA. But VA manual underwrites are very, very common. Okay. What that means is even if you don't get an AUS accept, we can do manual guidelines where we have a human qualify them basically instead of a computer. And their VA is a very easy one to try to get through compared to the other products that, you know, FHA offers manual underwrites, USDA, but VA is by far the most lenient, I would say. And most people, you know, if you're going to attempt at a manual underwrite, it's going to be a VA home loan usually. Overall, what you're wanting to look at is credit history in the last 2 years. Really is more than anything. If they have late payments, collections last 2 years, it's pretty much going to knock them out for manual underwrites. We're wanting to look at their history in general. But besides that, as long as they fit, you know, it's reasonable. You know, a manual underwrite is pretty you know, pretty easy on a VA home loan.
So
So
this is
I've done
this is
home
a
loans in the
question.
500s, you know.
Whether you're talking with possible clients or we're talking with them, this is a question that we're going to ask: is you know, are they VA eligible? Right,
Yeah.
because it's such a wonderful product for the borrower.
Mm-hmm.
It's definitely something that you want to make sure that you're asking. Never assume that you know one way or the other on that. It
Mm.
never hurts to ask that question.
I've had
A question.
many people in their, you know, 50s or 60s that are VA eligible, and they just forget, you know, they
Yep.
just forget that they're VA eligible because they bought a couple home loans conventional, you know. So
A quick question back to the USDA. Jackie asked, "What is the max purchase price on USDA?"
it depends. It's actually there's income limits for people.
Right.
So it depends on your household size and who's working inside your household. So you know, if I was gonna do a max purchase, typically you're not gonna run into a loan limit. Like FHA's loan limit is, you know, 600, you know, 564,000, and you know, at most
Yeah.
areas. You're not going to typically run into that loan limit. You're going to run into an income limit for people on family. Most
Yep.
people can't make more than 100 grand in a household, depending on where it's at. You know,
Yep.
so and that's a 4-person household. That's not a, you know, that's you, wife, and 2 kids. So you're going to typically run into that limit. But
Yep.
you know, I've done home loans at $300,000 on USDA. It's doable. It's just the ratios on USDA are a little bit stricter. So I would say max range is anywhere from 250 to 300. I mean, we're really pushing it, and it has to really fall together. Higher credit scores, stuff like that.
Yep. All right. Conventional.
Technically, it's a 620.
Yep.
But conventional recently, this would require a massive amount of money down to get this qualified at a 620. The mortgage insurance on it, if they're not putting 20% down, would be outrageous as well. I mean, this is just a not feasible whatsoever compared to FHA. Now, with that being said, even at a 680, sometimes we don't get people approved. Depends on their hit, like the length of credit they have. So I would say it really becomes more and more advantageous for a person to go conventional at 680 and above. So anything lower than 680, they're going to take massive hits on mortgage insurance. They're going to take massive hits on rate. Even if you compared FHA's mortgage insurance and interest rate combined, even if they didn't have mortgage insurance on conventional, you would still have a lower cost.
Yep.
And I try to explain that to buyers. Some buyers come in with a very, very negative view on mortgage insurance with FHA. And overall, we know the market. I know the market, we know them well enough. The market is that I know we're making it harder if we don't try to get people qualified for conventional. We do, but 9 times out of 10, it just doesn't make sense for them, or they don't qualify, it's just not quite there until they hit about a 700, 680 and above credit score.
Yep. All right, seconds. That could be a HE loan, a closed-end second, a HELOC, etc. 620 is the bare minimum for primary, and I'm talking bare minimum. That's going to be hard to make it work. Secondary and non-owner. Jordan, do you know, is it 660 or
660?
660?
660, and then non-owner is about closer to 680, but they can go down to 660. They're just not going to get as much money out, or
right.
the lower the score.
The max cumulative LTV is going to be lower, et cetera. There's going to be other factors to play
so
there.
all the ones we talked about above this, conventional, USDA, FHA, we all run an automated system that will tell us yes or no. Second mortgages and DSCRs are not. If they meet the guideline, they meet the guideline, right? So that's what the nice thing is about these products. So if you just fit in the box, you qualify. So I don't deter people from applying on those because if they fit, they fit, right? It just depends on how much money they want to pull out and how much money they want to put down.
Yep.
The goalpost moves on the other pillars essentially with the lower the credit score.
DSCR. Okay, I'm gonna put this. We do have lenders that will do DSCR at 575 plus. The problem is, most often the numbers won't work. Okay, so theoretically, we have lenders that are telling us we can do DSCR down to 575. The problem is the deal, generally speaking, it's really hard to make the deal work and get the property to pencil at that number. So again, theoretically we can. Generally speaking, it's going to have to be more like 620 plus, and
620
ideally,
to 640.
Yeah,
it's gonna at 640 they open themselves up to a lot of banks. That will do that. So
more ideal and many more options. Okay. And more flexibility on those kind of things. Okay. So any other buckets that we should be aware of as far as credit and specific loan types?
But you see a trend here. There's a trend. I don't know if everyone notices a trend. It's a real bucket of credit that you really want people in to start qualifying. It's anywhere from 620 to 640 almost on all products.
Yeah.
So that trend is, we keep that in mind when we're helping clients, right? Is when I'm looking at it and I'm looking at whether or not I'm giving someone, a lot of people don't know this. I used to own a credit repair company. And I really don't like the way credit repair is done in the US and the way that they have the subscription model and the way they pay. I think they overcomplicate a system that used to work years ago that doesn't quite work the same way today. And what I mean by that is today, it's a lot harder to dispute and get things removed from your credit, in general. You got to take a little bit of a different route. And not that we don't get things removed, I think we go into a more of a logical approach. And that approach is very simple to me. Think about your credit as like a boat. And when you have bad things on your credit, it puts holes in the boat every month that will bring your score down. Our goal is to plug the holes, right? Let's get it to stop bleeding. And you'll be surprised on how many people have $25 collections. right? In general, 25 or $50 collections. That whole, there is no big difference between a $25 collection and a $100,000 collection unless it's a credit card that's messing with ratios. Uh, so we take an approach of least to greatest, and we try to help clients, encourage them, put it on the fridge kind of thing, right? List it out and say, hey, these are the things that you should attack. Here's phone numbers. Here's what you need to do, and let people learn how to fix their own credit. At the same time, guide them. It's a very simple process overall.
Yeah, well, along those lines, this was a template that you had emailed me that is an example of what, after consulting with the potential client and getting a better understanding of their current credit profile and history, et cetera, this is an example of credit direction, and what that looks like and the recommendations, et cetera. And that will obviously be catered to a certain degree to their specific scenario, right? Their what they currently have on their credit history and collections and things of that nature. So along those lines, Jordan, what does that look like? We have someone who is they're motivated, they're interested, they want to qualify, that they want to buy a home. Um, and this ties into Jackie's question. Can you give some tips for credit repair and boosting, please? So what does
So
that look like? What are some
here, I'm going to tell you
that,
what some of the issues are when you're trying to review your own credit, on some
yep,
tips and tricks.
perfect.
Some of the issues are you just don't have enough info. When you're looking at like Credit Karma or you're looking at your free credit report, one, it doesn't have all three bureaus in one like easy fashion to review. And also, it doesn't really give you a streamlined view for you to look at a credit report and say, okay, these are the things that I need to do. So that number one is getting with someone that can actually pull your credit report, and give you a copy of your credit report to, we have every one of our clients pay for their credit report because we want to give them a copy when we're going through credit direction. We want them to see and really understand how credit works. But in the terms of what we look for, go ahead.
Jordan, can I just want to add something here, because this is something that's coming up a lot. And so I want to proactively address that here. The cost for credit reports has gone up
400%.
drastically,
Yeah.
over the last 24 months, like drastically. And so most often, for several reasons, we pass that cost along to the client. Now, that doesn't mean that there aren't exceptions, et cetera. But when credit reports cost 10, 12, $15, it's not a big deal. When they cost 70, 75, 77, $80 or more, it becomes a little bit more of an issue. So, we've had people that have referred us clients, and that came back as a something that was an objection or confusion, et cetera. But what we're able to then provide to that client once they have that report is worth well in excess of that 70, 75, $77 cost. And there are workarounds, and so forth, but I just want to proactively and transparently make everyone aware of that fact, if you're not aware. And it's so bad that in the industry we're lobbying to get those costs reduced once again, because it really is not helpful for the consumer.
I mean, I want to help everybody. I
Yeah.
think realtors work way too hard, or just our referral sources in general work way too hard to get people motivated to buy a house. The last thing I want to do, uh, uh, is not be able to help them to the fullest, right? And then when you're dealing with 100 people a month that are doing credit direct, I mean, it's a few $100,000 that it would cost us if we ate all costs. So now, with that being said, before I kind of talk about you don't get the full scope of everything that you need with all three. So that's a lot of times is like, a lot of people are like, I don't want to pay for the 77, or can you look at my free credit karma and tell me what to do? And I was like, I could, but you're very limiting me on what I can and cannot see, because one, it's probably not going to all be 3 bureaus, and it's not going to be listed out in a format that's going to be real easy to read. It'd probably take me hours myself, someone that knows how to do credit repair, to review a free credit report, compared to if I pull my own and I'm able I can get through it in 15 minutes, literally, on my own. So a couple of things that we look for when we're looking for credit repair. Number one is behind payments. That's for everybody. That's kind of well, duh, Jordan. You can't be currently behind on a mortgage and expect that your credit's going to improve, right? Or you can't be currently behind a car. But that's the first thing that we look for. Okay. The second thing is going to be collections. Okay. Any collection at all. But there's two things specifically I look for collections. One is the last report date. Okay. I'll give you guys an example, and people get into this, and this is where I don't like doing overall disputes with every single collection on your credit report. Okay. I think credit repair companies that come in and they'll sell you at like $125 subscription, they'll go in and they go in this dispute mode where we're just going to dispute everything and just see what happens, kind of thing. Well, if you had a collection on your credit report, let's say it's $35, and it hasn't reported in the last 2 years, okay, because sometimes they die off. After 7 years of once they die off, they'll fall off your credit report. But after 2 years, let's say they haven't reported, it's not hurting your credit anymore. This is not even affecting your score, most likely. And if you paid that or disputed it, you've moved it forward, and now it's a fresh collection.
Right.
Okay, so that's tip number one, is find out when the last time it reported. And then tip number two is what bureaus it reported to. I'll give you an example. When you're trying to qualify for a mortgage, you have 3 bureaus, right? When we are trying to select a score, to use, we always use the middle score to qualify people. So if I had a 700 on Equifax, a 500 on Experian, and a 500 on TransUnion, their credit score is $500. I mean, 500. Okay.
Yep.
For example, we systematically target certain credit scores. I'm not going to go in and wildly have a client pay every single one of their collections or dispute a collection. We try to go and say, okay, do we need to actually even do anything with this collection? Is it reporting to the right ones? Okay. Is it something that's
this is huge. I hope people are getting this. Just understanding this fact, that really what we need to focus on is there a quick, simple, easy way for us to improve that middle score to get us to the next tier, so we can get a better deal, or open up more financing options, opportunities, etc. Like, that is the value that credit direction and what we do, well in excess of like the traditional credit repair approach to things.
The credit repair reports, I feel like it's turned into a shotgun approach, is really what it is. And we want to go methodically. We're trying to get into a home loan. We're not trying to fix every single piece on their credit report. That's a much longer process. And I do encourage people after they buy a home is, you could go and pay, Lexington Law, and then they can start putting, disputes in and trying to file certain things. But that's for everything. They're not typically saying, okay, I'm going to get you to a 640, to get you into a home, so we want to methodically, that's tip number two, is methodically look at what score is your middle score, and does the collections that we're paying off make sense? Also, how much money do we have to put out to get them where they're trying to go? We have a multi-issue problem here. It's not just the credit score, but we also have to make sure people keep enough money to get them to qualify, to have the down payment, have the closing costs, and overall, we just want to save the money. We don't want to pay things that we don't necessarily need to pay. So there are instances where we go in and say, okay, we're going to just fix everything, but it's very rare. And a lot of times that client has a lot of money and they just need to know what to do. Right. And they just want to get everything taken care of. But most people don't. Most people are scrounging up to get the cash they need to buy a house. So let's not spend all that cash fixing their credit. Besides that, going into collections and methodically picking out which ones. When I'm going and approaching collections, I approach it in a least to greatest manner. So I'll give you an example. When I'm talking to a client, let's say I have 9 collections. The first 8 are less than $500. The last one is like $4,000. Collections don't disqualify someone from buying a house. I'll take care of the first 8, and then we will decide whether or not we do the last one. You see what I'm saying? So we go smallest to greatest. We want to give the clients a feeling that they're taking, they're taking a win, essentially. When they're not that they're shamed, right? But most people are not happy that their credit's in a certain situation. They don't know what
Sure.
they need to do. So I list it out from smallest to greatest, and I say, okay, let's just start with number 1. Let's start with number 1. It's $25. Call them, see if you paid in full, if they'll write a letter for deletion. If they write them a letter for deletion, I can delete it off their credit report like it never happened. We always want to offer this first. Okay. Number 2 is if they won't delete, we settle. They've already done the damage. If they're not willing to take it off the credit report, we settle on it. Or if they really don't want to settle on it, we dispute it. Okay. But let's say I have someone a total of like $5,000 in collections, small ticky tack, 14 collections, small stuff. We might over the next 6 months just settle on this, and we might get rid of it all for $2,000. It's the little wins that will keep them going to get them in the place of qualifying. And I will tell you, I can't tell you how many clients that we help them with credit actions that will refer their entire family after we fix the credit. And that's why we do a lot of it. Is the referral rate and the pre-approval rate for a referral from a family member is like 97%. It's like an outrageous. They usually have much better credit. They usually say, "Hey, Josh was able to buy a house. Surely whoever he is working with could help us." Right.
Yep.
And then you get more referrals. I get lifetime, clients. I have clients that call me and ask me just random financial questions that I did their home 6 years ago because I fixed their credit. It's a trust thing at a certain point.
Totally.
Neither here nor there. But that when we're going to collect, that's how we approach a collections, unless it's a credit card. Credit cards come first. Some credit cards in collections will actually boost the credit score. So, for example, because it's a ratio. So when you're paying a collection off, it's actually not going to boost your credit score. It's just going to stop the damage from every month. So it's not anything that's going to, if I pay off this, $2,000 medical bill, for example, right? Let's say it's hitting your credit every month and it's in the range, it's in the score that we're targeting. That is not going to improve your score unless it gets deleted. Okay. Unless it's a credit card. So typically I'll target credit cards first, because just paying off those 2, let's say we have 9 collections and 2 of them are credit cards. Paying those 2 credit cards off could get them where they're trying to go. We don't know necessarily. There are systems that we can run, but you can't really tell longevity wise on what the other collections are going to do, damaging their score each month. So typically we focus on credit card collections first. Then we focus on collections in general. We make sure that they're all reporting every month, right? They haven't stopped reporting, and then it's the right bureaus that we're targeting.
Okay.
Okay. From there, go ahead.
Yeah, go ahead.
Go ahead.
No, go ahead.
Okay. From there, we look at, once we have what I call, we stop the bleeding, right? We've stopped everything hurting. Your score at this point will naturally improve. It's just going to naturally improve every single month.
Right.
It might be 3 points, it might be 6 points, it might be 10 points, but as you pay your bills on time, there's nothing that would hurt you anymore, right? It's just time will eventually heal the wound. Our second step is manipulating the credit score. Okay. This would be, let's say you have maxed out credit cards and they're not late, they're not in collections, nothing like that. They're just high balances. This would be reorganizing it, maybe showing them a debt snowball, showing them what a debt snowball looks like, just overall financial tools to get them where they're trying to go, right? And we can run analysis on these where I could tell you exactly within 1 point on what that score would be if we paid down a credit card to X amount. Okay. It's very easy on our end.
What is that called in our credit platforms?
We have 2. Yeah, it's called a wayfinder and a what if scenario. right?
Yeah,
It's
yeah, yeah, yeah.
basically instructions and what they need to do to get their score up 30 points immediately or 40 points immediately.
And I mean that's a huge that's an incredibly valuable tool, right? To be able, we're not just guessing. Hey,
Mhm.
we think this will help you get your score to here. It's not a guarantee that it will, but it's at least something more in black and white and more concrete where people can see if I do this, there's a high likelihood that we'll get to where we want to be. I feel like it just gives them more confidence in the plan, that it's not just
That costs us
here's
money
what we
too.
think. What's that?
It costs us money too.
Right,
Yeah,
yeah,
it costs us money, not the client.
totally,
These are the one things that we do pay for. If they're close
yeah,
enough to where we're doing, that kind of stuff and manipulating that score, it costs us money, but it's close. That's what we just chalk it up as cost doing business, right? They're close
yep,
enough. They're most likely already qualified. So,
yeah,
but yes, it's an extremely useful tool to run this. I probably am less likely to run it nowadays versus doing general credit direction that we were talking about. It depends on what's on their credit report. If everything is positive on their credit report and they're just trying to improve it, absolutely. But if we have a lot of work to do to stop the bleeding, this is probably ran once we're done with that portion. It's in the secondary portion of manipulating the score. But let's talk about this. Let's say we have an instance where we have a 20-year-old kid that doesn't have help. Let's say he, has a card in one collection kind of thing. This is going to populate a very low score. Longevity is a huge part of
mhm,
credit, right? That's why when you see like a lot of people when we're talking to them, it's like, don't close out that car loan. Don't pay that car loan off in the middle of your process or right before you, apply for a home loan. I have people all the time that are like, why did my car loan, I just paid off my car loan. Why did my score drop 60 points? It's because you're closing out your longevity.
yeah,
Longevity is important. When you're going from one house to another house, you're closing out a long home, long loan and opening up a brand new one, for example. And a lot of people don't understand. It's like, I'm doing something good. I'm paying off debt. Yes, it's good, but longevity is better, right?
yeah,
And that's why important to have long credit card, don't close out accounts, try to keep accounts going for a long time. We can manipulate longevity. It's something we can actually do. So I'll give you an example. I'll give you a client I had. Her name was Amanda Hayes. Okay. She had no credit scores. Okay. She was 18 years old. Okay. Grandma. So back in I want to say 30s and 40s, somewhere around there, credit reports were merged when you were married. Typically, women stayed at home, homemakers, and men worked. And when they separated credit reports, okay, and it made where Josh and your wife have separate credit identities, even though you're married, uh, they didn't have a credit score because they didn't qualify for loans. They were homemakers. They didn't qualify for loans. So credit card companies came out with a system that you can add authorized users and you could adopt that credit history. And
mhm,
it allowed people to populate credit scores. That system still exists today, and you can do it with anybody. Okay.
mhm,
So Amanda, I had her, and it only works with certain brands, such as like Discover, Chase, Capital One. These have been around forever, right? It's not going to work with your local credit union. It's going to work with these large brands. But uh, you know, Grandma Hayes essentially had a card that was like 30 years old for Discover, low balance on it, and she's always made perfect payments on it. We added her to that card, and then 30 days later, Amanda populated an 801 credit score. You know, so this 18-year-old kid has now an 800 credit score to qualify for a mortgage. We will do this at times if I see there's a big lack of credit history,
yeah.
right?
I,
If it's very
we did,
short.
didn't we did this recently with a mom and a son or something.
Yeah.
We have, this isn't just like theoretical. It's theoretical. Like we're implementing these strategies
Yeah, no, I do
um,
it quite often. It just
when it
depends.
makes
There's
sense.
companies out there you can
Yeah.
even, I have a guy that will jump them on, for $500, will jump them on their credit card, depending to populate longevity. So it's not, I mean, there's companies out there that'll do it. There's, I usually try to go with family. It doesn't affect them at all. Like that's one thing is like how, for me, for example, my kids, I have a 12-year-old and a 10-year-old. They're on my credit card, my Capital One card. Their credit's frozen, but they have 700 credit scores. They don't have to be necessarily 18 either. So when they turn 18 years old, they can go buy their own car and make a late payment on their own car and ruin their own credit. They would have the credit.
Why are you putting that on them?
Yeah,
Why is it got to be?
it's got to be. They're not going to put it on me though, Josh. That's my point. It's not. Where if that credit card misses a payment, I just remove them from the credit card,
Right.
right, and it disappears. Right, it comes on as fast as it removes. So a lot of times we'll have people jump on a credit card, from mom, dad, brother, sister, get the score they need, buy the house, and then they remove them the card, a few months later, and then they have a mortgage on there to help them, build their credit,
Yeah.
right?
Yeah.
But their credit will drop drastically usually. Credit cards are the biggest improver of credit. So that's why jumping on as revolving debt a lot of times is it's a good idea.
Right on.
Okay. There are other things that we do to manipulate credit, and this is where I view disputes a little differently. Disputes are hard to get through. You need a reason, right? It's not like it was in 2008. Like if this was 5-10 years ago and I was talking to you guys about credit direction, we'd dispute everything, literally everything. There wouldn't be a single thing that we do. We'd do the shotgun approach and we'd probably get half of them removed at least. There are a lot of good credit bureau companies that will do the research, put it together, and find out where they messed up, where they didn't notify them the right way, or they didn't respond in the right way, and they'll get disputes removed. But for the most part, it's much more difficult than it was in 2008. Okay, when they really started implementing these. And so, but I use disputes in a different format. I'll give you an example. Let's say we have a client that has some good credit history, right, Josh? There's like 3, like a car loan, maybe 1 credit card or whatever, but they have 10 collections that we just paid off. Disputes and mortgages, there's mortgage rules around disputes. You cannot have a dispute on your credit that has a balance over $1,000 and still get a mortgage. Okay, period. Right? You would have to remove that dispute, which I had a loan officer that I, teaching right now that started a loan with a dispute, and he removed that dispute and it dropped them 40 points. They no longer qualify. So it's important as loan officers to be looking at the credit report to see if there's any disputes. Okay. But what we do is if they're paid off, they're not more than $1,000 balance. So I have given myself a 60-day window because disputes take about 60 days to respond and resolve, right? Credit reports on our end last for about 60 days, okay, until we have to repull. I will go and dispute all 9 of those collections. And then once a dispute goes in, it takes it out of the factor of the score. We will get a temporary score for 60 days in the 700s, usually, because it's only good credit on the credit report at that point. I want to say it's a risky move, but you can't dispute over and over, and you only have a 60-day window. So this works for someone that maybe already has an idea that they're going to have a contract pretty soon. Maybe it's a brother or sister, they're buying a house. You know what I mean? Like it works in certain situations, but it is something that can be done. It's not done often just because we have a very short window. And if we're in a market where houses were going a little easier and a little more inventory, it wasn't so hard to find something, this would probably be more prevalent to use.
So the risk is we're doing this to get qualified, but we haven't found the house yet. So if we can't find the house and get all of that knocked out in 60 days, we could actually be doing more.
You could be
harm
reverting
than
it.
good, right?
Yeah.
So
you could be reverting back in the middle of the process if we have to rerun credit, and that could drop the credit score, and then we can no longer qualify and we'd have someone under contract.
So there's a risk reward to that. And there are scenarios where it would make sense. If they're looking for a new construction home and there's not multiple offers, et cetera, that might make sense, right? If they've got the inside track on a home that's not officially on the market, right? Like an off market, there are certain scenarios where it can make sense, but it's important that we explore that and properly assess the risk reward before proceeding with a strategy like that.
Yeah, I typically won't even bring that up to clients until the right situation arises. But it is doable. It is something that is possible. It is something that they could contact and dispute the bureaus. But again, it has to be certain bureaus, right? We're targeting, it's methodical. We're not just disputing everything and absolutely everything. We don't want to dispute things that haven't reported in years. And we only then want to dispute stuff that is going to impact our score in the right direction. So having the right credit report, number one, is going to be super crucial there. In getting them to qualify.
Yep.
I really don't think that Credit Karma and them just give the information that you need to get you
it's an incomplete view of the totality of the.
And I think they do that on purpose. I really I don't think they, and since we pay for it, it's through a credit company, through a mortgage company for us, they give us the full scope. So
I'll throw out one other thing here, just for FYI. We do have certain scenarios, primarily when working with investors, where a soft pull will suffice. We have some HELOC products that allow for a soft pull and some hard money DSCR that allow for a soft pull on credit. I share that because for some investors, that's a big deal. In fact, I recorded a little short form video on that very concept, that idea, late last week. And if that's something that if you have a client or you yourself might want to explore that, A, you can reach out to us. We'd be happy to chat. And B, you might want to use experianboost.com before that, which is a little, a potential way to get a little boost on your Experian soft pull, because most of those products are going to look at the Experian soft pull score. Jordan, anything else along this topic before we wrap up and come in for a landing?
No, not unless there's specific questions on credit, but for the most part, everyone kind of follows the same model on what I look for, right? Same kind of guidelines on how to generally improve their credit. I would say the biggest thing is keeping them encouraged. When someone's applying for a mortgage, right? And you're talking about, they don't realize 75% of people do not qualify, right? They have to work on their credit some way, or
that alone is helpful for them to know.
Yeah. So, when I'm talking to them, I try to keep them as encouraged as you can, that this is something that's possible. And as long as they follow guidance, and I make a joke with them all the time. I don't charge people for credit direct. This is 15 minutes of my time. If they pay for their credit report, it's 15 minutes of my time. It's not anything that's gonna, my goal is to really help them get into houses. So I make a joke with them, and as long as they have forward movement over a 9-month period, they've had a long enough time to have a baby, they've had a long enough time to pay one collection, right? As long as they have forward movement, I will work with them for years. It doesn't matter what it is. To me, it's a pipeline. It's your guys' pipeline. It's your lead that you called 17 times or 16 times, or you paid money, or you did something with. I want to be able to, in a year, 6 months, maybe 3 months, maybe even 30 days, to come back to you and say, hey, and typically when I refer back, credit direction leads, they don't, most realtors just completely forgot, because most lenders don't follow up with that.
Like found money.
Yeah. So I want to come back and be like, hey, you remember Stacy? It's 6 months later, you referred her 6 months ago. She's been in credit repair. Here you go. But I follow up with them every 3 months. And as long as by the third follow-up, they have done something, again, we start least to greatest for a reason.
Yep.
I want them to just chip away at it. And as long as they chip away at it, they will get there. Absolutely.
Yep. So 3 possible next best steps for all of you listening here. Number 1, you may have someone that, or you may be the one that is looking for some credit direction. If so, you can reach out to Jordan or I. Our information is in the chat. You'll also find it with the description of this video if you're watching afterwards. Number 2, if you have, an investor looking for DSCR or hard money or different scenarios, if you go to the QR code here or joshvips.com, there are lots of different intake forms, depending on the situation or scenario. Third option is, and you may choose all three of these options. It's totally up to you. We can, for those that are interested, build out co-branded mortgage application links so that you have an easy way to refer us potential clients. That is oftentimes where we direct folks to begin an application so we can start to get an idea of the picture of their financial situation, so we can determine where we might look at. What do we need to do? What do we need to address? Do we need to look at credit direction? Are we looking at FHA or VA or USDA? What are we looking at there? And for those, you can just reach out to mike@growwithjosh.com. I'll put it in the chat, mike@growwithjosh.com, and we can build you a co-branded link. It'll have my information, it'll have your information, and it's an easy way for people on their phone or on their laptop or desktop to create an account and get started with the mortgage pre-qualification and pre-approval process, so that we can help them in some form or another. Jordan,
Yeah.
thank you.
Miguel, yes, I have a loan officer that speaks Spanish, so yes.
Yeah,
we do.
Miguel asked, do you guys work with people that only speak Spanish? Yes, we do have a Spanish speaking LOA, and we would love the opportunity to connect the two of you. And in fact, Miguel, if you don't mind, I'll connect you with Maria so the two of you can can get to know each other, and we can even get you the co-branded link, so that we can get all that working if you have any Spanish speaking borrowers who would like to explore mortgage options. Good stuff. Jordan, thank you, sir. Once again, if you missed any of this or you would like to review, we will have the on-demand replay of this. It'll be available immediately after at the link that led you here, joshvips.com/credit. We'll also get that uploaded within 24 to 48 hours at Wake Up Real Estate, which is our YouTube channel, or at wakeup.realestate. Monica asked, and Jordan, I think you had another note there, but Monica asked, so would you recommend getting a link together to share with our clients first? I think that makes it easier, but certainly you can warm hand them off to us as well. It's whatever you're most comfortable with, quite honestly. And I also think it depends on what they're most comfortable with, right? If they would prefer a warm handoff to have a conversation, that's wonderful. If they would prefer to start an application, that's wonderful as well. And actually, I'm going to add a fourth option. I totally forgot about this. Another way that you can refer clients is go and create your free account at wakeup.realestate. Create your free account at wakeup.realestate. And then there's lead capture tools and lead capture pages, including a bunch of mortgage specific lead capture pages that you can use to give some, to whether with your email database or on your social media, et cetera, to generate some conversations and opportunities, including one for credit direction. Mike, I didn't even realize this one was in there, so I need to get that to Campbell. But that is another easy way for you to refer potentially interested clients as well. And Jordan, I don't know if you if that was you clearing your, I don't know. I thought you were.
What's up, brother?
Yeah, okay.
No, I'm good.
That's like, it's constant. Like my kids, it's like,
I know.
seriously, they just walk
My
in the
kids
house.
are doing it, yeah.
Yeah.
Anyway.
Oh, and many on here have no idea what we're talking about. Sketch. I don't know. Get with the get with the times. Anyway, thank you. Great crowd, great questions, Jordan. Thank you for your expertise and sharing. And we look forward to chatting with many of you real soon. We'll be back next week, same time, different topic. We'll let you know what that topic is later this week or early next. But you can mark it down in your calendar. Tuesdays at 1 Eastern. Tuesdays at 1 Eastern. If you want to increase your mortgage and financing knowledge, you should make a note to join us every Tuesday at 1 Eastern. Thanks again, and chat soon.
All right, thanks.